Ask these 14 questions. In this episode, I'm going to address the question, how can I tell if a financial advisor is proficient in structuring an IUL? What's an IUL? An Indexed Universal Life Insurance Contract. And I'm going to go through 14 questions that could help you tell immediately if an advisor, even an insurance agent, really knows what they're doing in structuring it correctly. And you will be able to tell almost immediately if an advisor, an insurance agent, is proficient in structuring an IUL in the right way and funded correctly so it can perform at its optimum level for you and your financial goals. So I'm Doug Andrew, and what do I know? Well, I have been using Indexed Universal Life Insurance since 1997 when it first came out. I've been using Universal Life for tax-free accumulation, tax-free income, tax-free transfer ever since E.F. Hutton, the brainchild behind it, came out with the idea in 1980. In fact, most CPA firms and large tax law firms have contracted us to come and teach them about 3 sections of the Internal Revenue Code as it relates to max-funded IUL, how they allow someone to accumulate their money tax-free, and then be able to access the money tax-free for 30 or 40 years in retirement and not deplete their principal. And when they ultimately pass away, it blossoms in value and transfers income tax-free because nothing else in the Internal Revenue Code actually does that. And so throughout my history of helping people do this, many times people will say, well, how can I tell if an insurance agent or a financial advisor is proficient? I'm going to tell you a horror story and why this concerns me so much. Many times I will go out and speak and teach. I have written 11 books so far. And sometimes people will read and get insights into this opportunity. They sort of find out. So which companies do I use? There's only about 5 or 6 companies out of over 200 that offer Indexed Universal Life that I would put my money into because I am very, very picky about which companies. And then there's only certain products with those companies that I would put my money into, but it's really how it's structured. It has to be structured correctly and funded properly in order for it to perform like a tax-free cash cow. Many times I would go through and people would find out the company that I like to use or the exact name of the product. So they would then contact a relative that had a license, or sometimes the relative invited them to watch a video that I had produced or come to a seminar, and they would say, now, let me help you set this up. Well, this is the saddest because many times, I'll never forget one couple, they heard me on the radio, and I basically said, okay, the last 7 years. Now, this could have been from the year 2000 to 2007. It could have been from 2008 to 2015, because both of those 7-year periods, people who had max-funded IUL doubled their money. Now, if you know the rule of 72, they doubled their money in about 7.2, 7.5 years. That's averaging over 10%. And so they go, what? I've never seen one do that. And so I would be on the radio and go, well, now if you started out with $500,000, let's say, 7 years ago, your $500,000 would be worth $1 million right now, 7 years later. If you started out with $1 million, it would be worth $2 million now. And if you started out with $500,000 in the year 2000, it would have doubled to $1 million by 2007 and would have doubled again to $2 million by the end of 2015. And people would hear me say that. Only a few, maybe the rest were too embarrassed. They didn't understand it. They thought maybe I was fibbing or not telling the truth. But they came in and they would say, Mr. Andrew, we put $500,000 into an Indexed Universal Life 7 years ago. And our $500,000 is only worth $250,000 now. What happened? What do you mean it should have been worth $1 million? In other words, we should have had an extra $750,000. And I go, Yeah, let me see that. And I would look at their insurance contract, their policy, and in about 2 minutes, I could tell what was wrong. And I would say, who designed this for you? And they would sheepishly go, our nephew or my brother-in-law. They have an insurance license, and they assured us that they were using the same company and even the same product that we told them that you were using. I said, well, yeah, it's the same company. It's the same product. But they had no idea what they were doing. They made this account 4 times bigger than it needed to be. I mean, you could have been earning 11 and netting 10, and instead you were earning 11 and only netting 5. Oh my heavens, or netting less than that. They designed this maybe to help their wife and kids more than your wife and kids. I'm sorry to say this, but that was an expensive relationship with your nephew or your brother-in-law. You can't believe how many times I have had similar horror stories like that one. So when we wrote our most recent book called The L.A.S.E.R Fund, this book is 300 pages that contain charts, graphs, explanations of how this works. It also has a second book when you flip it over that contains 62 actual client stories. But on the left brain side, in the one of the last chapters on that 200 pages, it's titled, What Can Go Wrong? And in fact, on the right brain side, out of usually 4 or 5 success stories, I always share a story of one that was done wrong. And it's usually been done wrong because the advisor was not proficient almost every time. Or else the client structured it to accommodate $50,000 a year and they only put in $2,000 a year. They way underfunded it or something like that. So it's very obvious what goes wrong. But the most common reason was that the advisor was not proficient. So that motivated us to write in this chapter a L.A.S.E.R ready test. L.A.S.E.R stands for Liquid Asset Safely Earning Returns. So I'm going to share with you some of the questions that you can ask so that you can find out if that advisor really knows how to do it correctly and if they're proficient. You ready? So here we go. I'm going to read right down these questions, and you can get a copy of this book for free. I'll show you how here at the end of this. This is question number 1. What is TEFRA, DEFRA, and TAMRA? Those are tax citations. And how do they impact my policy? Now, your financial professional should be able to answer this off the cuff. If they say, well, let me check on that, they're likely not prepared to structure one of these things properly for your benefit. So you might want to cross-check their answer with what's in the book here. Next question. Explain to me Internal Revenue Code sections 72E, 7702, and 101A. Again, an advisor that's proficient will know what those 3 sections of the Internal Revenue Code entail off the cuff. If they say, well, I don't know that, I'd have to look it up. Hello, that's a danger signal. They don't know what they're doing. Next question. What's a guideline single premium? See, this is the total amount that you will be able to fully fund that you design into the policy in the first 11 years, and the fastest you can do it is in 5 years, or you can take 20 years, but it's called the GSP. If they don't know what that is, they don't know what they're doing. What factors will the insurance company consider when gauging the size of my policy besides the GSP, Guideline Single Premium? So this includes your age, your gender, your health status, and so forth. They ought to know that. Next question. What size policy would someone have, on average, who is a healthy 60-year-old male with a GSP of $500,000? Now, if they have done this, even remotely enough, they should know off the cuff, about 1.2 to 1.3 million of death benefit. If they don't know that, if they go, I don't know, I'd have to go check it out. Hello, they don't know what they're doing. They have hardly done this. Here's the next one. What are the rules for perfecting a modified endowment contract? That's often called a MEC. If they don't know off the cuff the rules to perfect a MEC, hello, they don't know what they're doing, and they could cost you unnecessary tax. Here's the next one. How can an insurance company earning 5% on their general account portfolio afford to credit a policy 7% or 8%? Now, If they don't know right off the cuff the answer to that question because of linking to an index and how you're allowing the company to take the interest on what you're earning in their general account portfolio and buying upside options, if they don't know that, that is a huge red flag. How can a company earning 5% on their general account portfolio afford to pay you 7 or 8 or 9 or 10%? They better know the answer to that or beware. Here's the next one. How can policy holders experience 1 to 2% higher payouts than the average index that they are linked to? In other words, if the insurance company is paying out an average of 7 or 8% with their indexing, how can they afford to give you 10%? In other words, on $1 million nest egg or cash value in the insurance policy, how can the insurance company afford to give you $100,000 a year without depleting principal when the index is only earning 8? If they don't know the answer to that question, hello? If they say, well, I don't know, I don't understand that, it's because of the arbitrage of accessing your money via an indexed loan where you're borrowing money at 5% and you keep earning 7, 8, 9, 10, or 11%. This easily allows you to be able to access about 2% more in payout without depleting your principal than what you're actually earning on the index. This is an incredible way to have tax-free cash flow about 2 percentage points higher than the actual index rate that you're earning. Now, many advisors don't understand that one. Next, who runs your policy illustrations for you? If they say some clerical person or the home office, no. A professional will insist that they actually create those themselves because it takes an expert tweaking the illustration for you to squeeze down the death benefit under TEFRA, DEFRA, and TAMRA and to help you have a contract that if it earns 11, it nets 10. Otherwise, you will have maybe a policy that if it earns 11 will only net you 6 or 7. Hello, it's going to cost you dearly over time. Here's another one. If I maximum fund a L.A.S.E.R fund, an I.U.L, over the life of the policy, what is the expected net internal rate of return likely to be? That should be within 1%. And if they happen to say that, say, show me. And if they can't show you that the internal rate of return cash on cash is within 1% of the gross rate of return, they're not designing it correctly. Again, you could be earning 11 and only netting 5 or 6 when you should be netting 10 if it's not done right. How long have you been structuring these types of policies? Now, do you have access to several different types of index policies? If they only sell for one company or only one, hello, then they're only doing one size fits all advice for you because all different companies and policy features are different for what your goals are. Here is another question. Do you specialize in maximum funded index universal life policies or do you handle a lot of other insurance as well? If they're selling car and auto and homeowners and whole life and all these things, chances are they do not do indexed UL enough to really be a professional in structuring it right. Second to the last question, how many insurance companies do you represent? Now, if they only work for one, chances are they only have one product that they're allowed to sell, and it may not be the best one. That's why the professionals that I point my students to usually have access to 5 or 6 of the best companies that I've usually vetted and that I put my money in myself. The last question, is insurance your sole profession or is it a part-time endeavor? If they say, well, yeah, I'm a barber by day, but I sell insurance by night. Hello, you want to make sure that they have immersed themselves as a full-time professional in doing this so that they know what they're doing. So I would recommend that you ask questions. Those are hard questions, but if you don't get the proper answers, that should be a red flag, and you ought to seek out an I.U.L professional. And sadly, they're few and far between. But if you would like to know how to ask those questions and know the answers yourself, get a copy of the L.A.S.E.R Fund book. Now, whoops, this is the left brain side. This is the right brain side. And I will send one out to you absolutely free. I'll pay for the book. You just pay $5.95 shipping and handling. Go to laserfund.com, laserfund.com, and you can learn as much as you want in 3 levels of depth with charts and graphs, or you can flip it over and also read 62 actual client stories of how this is the superior vehicle for retirement, college funding, business working capital, for emergencies, for real estate management, and on and on and on. So here's to your brighter future.